A very good morning, friends. So I hope you're all doing well. Welcome to you all to the ICA Board of Study live classes. And today we've got a very interesting topic to start with. And it's a pretty long topic as well, but a very important topic at the same time from the examination point of view. I would say this is a plethora of standards. I'm talking in terms of business combination and in terms of consolidation standards. I guess one of the technical areas on the INDES, but of course, very important from the examination point of view, because if you consider the weightage of this particular INDES in the examination, invariably, I'm not saying always, but invariably, you do get a question on business combination and you do get a question on consolidation. So on an average, at least almost 16 marks is almost assured. It could go up to almost like 20 or 24 marks as well. So which means on an average, I would say almost like 20% content in the paper is expected out of the plethora of standards we're going to cover, from business combination to consolidation. And consolidation has got a couple of standards like 110, 111, 28, and there is a separate financial statement standard also, which is INDES 27. Now, to begin with, of course, there is no presumption that you've got any base as far as these standards are concerned. So we're going to start with the minute details and, of course, take you to the larger levels as well. So what I'm going to do to start off with you, I'm just going to first of all create a chain of thought in your mind, because I think at the first instance, one needs to be very clear in terms of which standard would apply in which area, because sometimes we do falter in terms of that, in a given situation, which standard is going to apply. So at the first beginning itself, what I'm going to do, I am going to first of all give you a clarity of thought that in a given situation, which standard would apply. But I think since we are starting with business combination INDES 103, before I create the chain of thought, I think it is pertinent to look at the definition of what is a business combination. So I'm just going to first of all look at the definition of business combination and then develop a chain of thought in terms of which combination, which standard would apply. So let's begin the journey. And I think in the first instance, let me just share the definition of business combination. So I've just taken a little extract of the standard where the definition of business combination is given. So let's have a look. Let me just zoom it further to you. And I'm looking at the definition of business combination, which is given out here in the standard. I guess visibly it's clear to everybody. So let me just read the definition to you and take the journey forward. So very good morning to all of you friends. Once again, a very good morning. So let me just read this to you. I'm not reading the entire definition. I'm just reading a very basic portion of the definition. The focus is in terms of business combination. And if I read the definition, it says a transaction or other event in which an acquirer obtains a control of one or more businesses. So I think there are some keywords in the definition which needs a little emphasis. And the keywords are that it is a transaction in which the acquirer obtains a control, that is one, of one or more businesses. So what is important is that for a business combination, you need to prove in that you are getting a control over the business. Let's not take it one or more business right now. Let's consider a single business. So what is my mind thinking is that you are basically going to get a control, that's one, and you are going to get a control over the business, that's two. So there are two key focus words that you need to get a control, that's one, and the control has to be over a business. Now, immediately the question what comes to the mind is, what is control? How do you assess the presence of control? The second question arises, what is a business? Nobody, these questions will definitely get answered. Okay, now with this particular definition, what I'm going to do, I am going to create a simple three-step model in which we're going to work upon the different permutation combinations and see that does index 103 get triggered, and if not, which other standards are going to trigger. So watch this carefully. Let me just come back. With this definition, let's create a simple three-step model to you. Well, I think one thing which I would say that the index makes it very clear is that you need to basically identify what did the company acquire. So the very first question what I'm going to put across to myself is, what did the company acquire? So I would say that there are two possibilities. One is that you acquired a single asset. Now, I can assure you that if you acquire a single asset, it can never be a business. Now, since Index 103 focuses on getting a control over a business, so it is very important that did you acquire a business or not? So the very first focus question, what we're going to put across to ourselves is that what did we acquire? I think let me just start giving you some notes also in between. You can start noting it down. So I'm creating a chain of thought at the moment. I've not formally started with Index 103, but I'm just giving you a chain of thought. So in terms of the chain of thought, I'm giving you a three-step model. So we start with the step number one. The very first step which I'm going to put across to myself is, what did we acquire? So we'll put across the question, what did we acquire? So we'll put across a question that what did we acquire? Now, the answer could be that we either acquired a single asset. The answer is that we either acquired a single asset or we acquired a group of assets. That is the first pertinent question. So did we acquire a single asset or did we acquire a group of assets? Now, let me also tell you, when I say that you acquired a group of assets, it doesn't mean that it is only a composition of assets and no liabilities. When I use the word group of assets, it can be with, without liabilities. So when I say group of assets, we are saying it can be with or it can be without liabilities, whatever. So let's not get into the confusion that group of assets would only mean that we are acquiring assets. It is assets with, without liabilities, whatever the case might be. Now, one thing is very clear that if you say we acquired a single asset, it can never be a business. It can never be a business. So in this particular case, I would put across a small question further. So the moment I say that I acquired a single asset, I will say, okay, let's put across another question to yourself, that the asset which you acquired was tangible or intangible in nature. Because when you're acquiring a single asset, you need to be very clear in terms of which standards would trigger. So I would say, okay, let's put across a question. Did we acquire a tangible or intangible asset? I'm putting it as T and IT, tangible and intangible. Now, the moment I lead to a conclusion that it is a tangible asset, the standards which could trigger, of course, the other definition characteristics need to be met, but apparently it could be Index 16 on a PPE, or it could be Index 40 in terms of investment property, because these are the standards which are devoted to a tangible asset. So we can say the moment it is tangible, it could trigger the application of Index 16 or it could trigger the application of Index 40. And I think needless to make a mention that if you're looking at that the asset is intangible in nature, then in this particular case, we've got a standard that is Ind AS 38. So I think the chain of thought would be very clear at the moment. So the moment a company lands up acquiring a single asset, it cannot be a business for sure. A single asset can never be a business. And if it is an acquisition of a single asset, we would simply put across a question, what is the nature of the asset? Is it tangible or intangible? So you need to look at basically the nature of the asset. Depending upon its tangible or intangible, accordingly, we lead to a conclusion which index would apply. Interesting. Now, the moment you say that it is a group of assets with or without liabilities, so in this particular case, what I'm going to do, I am going to go to the step number 2. No hurries. So we're going to go to the step by step number 2. Take your call, go on a step-by-step basis. You'll never ever go wrong. Now, once you've zeroed down that it is a group of assets which have been acquired, we go on to the step number 2. Now, in step number 2, there is a crucial question to be put across. And that is this group of assets supposed to be a business? Because the business combination standard would trigger only if you acquire a business and you acquire a control over the business. So, my step number 3 is going to be that I will see that did I get a control or not. So in the second step, the focus is that is the group of assets. The focus is that is the group of assets. And as I said, group of assets could be with without liability. So that's implied. So I'm going to put across a question that is the group of assets a business? So that is the key question, that is the group of assets supposed to be a business? Let me put a square against it. That's the focus word. Now the question rises, how do you say that a group of asset is a business? No worry, we are going to study this in detail today. How do you decide that a particular group of asset is a business? So we're keeping that question pending for the time being. So you just need to evaluate in step number 2 that is the group of assets supposed to be a business or not. So we are going to get the answer either a yes or we're going to get the answer either a no. Now, if the group of asset is not a business, one thing is pretty sure that Ind AS 103 cannot apply. But interestingly, though Ind AS 103 would not apply, there is a guidance which is given in Ind AS 103 that when you acquire a group of assets which is not a business, how do you allocate the total consideration amongst the various assets acquired? I have a small little practical illustration also on this area, but before we take you to the illustration, I'm just coming out of this and I just want to take you back on the standard where we give some insight on one of the inputs. So let me just come out of the step-by-step model and give you something which is given in the standard. So we can see that in terms of the standard, there is a slight interesting clarification which is given. Let's have a look at that clarification. So we are given out here, there is a scope of the standard. The scope of the standard tells me that where Ind AS 103 does not apply. The scope is telling me that where Ind AS 103 would not apply. It says the acquisition of an asset. I think that I've already covered in step 1. That if there is an acquisition of an asset, a single asset, in any case, Ind AS 103 cannot trigger. Or it says a group of assets that does not constitute a business. So that's what I'm covering in the step number 2. I already said that if it is a single asset, 103 doesn't trigger. And if it is a group of asset which is not a business, then also 103 doesn't trigger. But the standard has still given us a guidance in terms of what is to be done. Because if you're acquiring a group of assets, you would pay a consolidated consideration. And the consolidated consideration is to be divided between the various assets. Ind AS 103 is not applicable, but it still gives you a guidance of what is to be done. It says in such cases, the acquirer shall identify and recognize the individual identifiable assets acquired. I'm leaving the brackets. And then it says the cost of the group shall be allocated to the individual identifiable assets on the basis of relative fair values at the date of purchase. Such a transaction does not give rise to a goodwill. So he's telling me that whatever is the total cost which you paid for the group of assets, that needs to be allocated to the individual assets and liability in the ratio of relative fair value. So let's say, for example, you acquired 3 assets. You paid a total consolidated consideration of, let's say, 1,200 crores. That 1,200 crores is to be divided between the 3 assets in the ratio of relative fair value. So coming back to the picture. So as I said that if, sorry, oh my God, suddenly the board went off, not an issue. It'll get saved. So in this particular case, if I come back to my step number 2, so when we say that the group of asset is not a business, Index 103 is definitely not applicable, but there is a guidance which is given in the standard 103. So when the answer is going to be a no, when the answer is going to be a no, in this case, we can clearly say that Ind AS 103 is not applicable. But there is still a guidance which is given in the standard. So we can say there is still a guidance in the standard. But we are given a guidance. And what is the guidance? The guidance is that the total consideration shall be allocated. The total consideration shall be allocated in the ratio of relative fair values. How do we do this? I'll take a practical example to illustrate this. There is a very interesting example which is given in the education material as well. So the Institute of Chartered Accountants has issued an education material on Ind AS 103. So we're going to take a bit guidance from certain areas from the education material as well. So the moment you say that the group of asset is not a business, 103 is not applicable, but at the same time, Index 103 at least gives you a guidance that what is to be done. So whatever is the total consideration, you need to allocate that between the various assets in the ratio of fair values. Okay, now if you say, yes, the group of asset is a business, we're going to go to the step number 3. Don't worry, I'll consolidate these steps once again to you. So you need to go on a step-by-step basis in order to understand when does Index 103 get triggered. So at the first instance, you need to see what did you acquire. Is it a single asset or a group of asset? So one thing is very clear, that a single asset can never be a business. So depending upon tangible or intangible, the standard 16, 38 or 40 would get triggered. And if it is a group of assets and it is not a business, then also 103 cannot get triggered. But it's only when you say that, yes, it's a group of assets, 1, it is a business, that is 2, then we go to the step number 3. Now, let's see what is the step number 3. So once you've concluded in terms of the step number 2 that yes, the group of asset is supposed to be a business, now the focus is to understand, did you get a control or not? Because only if you get a control over the business as per the definition, then a business combination standard would trigger. So I would put across a question, did we get control? So did we get a control? So this is the focus word, that did we get a control over the business or not? So the answer in this particular case could be a yes or a no. So we could either say, yes, we got a control, or we could say, no, we did not get a control. Now, the question again, what comes to the mind is, how do you assess that we got a control or not? Now, per se, let's consider generally, I'm using the words very carefully, generally, you will get a control when you acquire more than 50% voting power in a company. Though control is not a rule-based assessment under Ind AS. The concept of assessment of control is given in Ind AS 110. Ind AS 110 gives us a principle-based assessment. There can be a control even if you don't have more than 50% stake. There may not be a control even if you've got more than 50%. So I may get a control if I've got less than 50. I may not get a control even if I've got more than 50. So it is subjective, but that assessment of control is what we're going to learn separately in Ind AS 110. So for the moment, let's assume that control is based on you get more than 50% voting power. And I would say, okay, you've got a control. So that's the understanding so far. So we say, did we get a control? If the answer is a yes, now watch this carefully. If the answer is a yes, there are going to be a plethora of standards. Number 1, So we would definitely say that Ind AS 103 is applicable. 100% that Ind AS 103 is applicable. And along with this, there are certain other standards which would trigger. The moment you acquire a control over business of a company, you would also trigger the consolidation standards. In other words, we can say that if I get a control over the business of a company by way of voting power, I would be required to make two financial statements. I would be required to make a separate financial statements, and I would also be required to make a consolidated financial statements. So the moment you say that you acquired a control over the business of another company, it is indicative that the other company is a subsidiary. So since you've got a control over a company, you're required to make two financial statements. One is a separate financial statements that is prepared by virtue of Ind AS 27. And you're also required to make a consolidated financial statements, and that is by virtue of Ind AS 110. So along with this, you can say there will be two more standards. You would be required to make a separate financial statements, which will be in accordance with Ind AS 27. You would also be required to make a consolidated financial statements, and that would be by virtue of Ind AS 110. So you can say that there will be a total of three standards which will trigger in this particular case. The moment you say you acquired a control over the business, you are applying 103, you are applying 27 for separate and consolidation. But let me also clarify one thing very interesting. Ind AS 103 is going to be a one-time application. This will apply to the company only once. In the sense, only once for a given acquisition. If a company acquires a business of another company, you would apply Ind AS 103. That's a one-time application. But making a separate and consolidated financial statements is going to be an yearly exercise. You're going to prepare your separate and consolidated financial statements year by year, every year. So that's the difference, that 103 triggers only once. And 27 and 110 is going to be an application which is going to be year by year. Okay. And then if you say, no, I did not acquire a control in this particular case, if you did not acquire a control, then there are various possibilities. In terms of which combinations would occur. Maybe you got a joint control. Maybe you got a significant influence, or maybe there is neither a joint control or significant influence, and that means that you are basically a passive investor. So the possibilities which could arise, that if there is no control, it could be a case of a joint control. How do you assess a joint control? This is given in terms of Ind AS 111. Ind AS 111 tells you that how do you assess the presence of a joint control? And if not a joint control, it could be a case of a significant influence. It could be a case of a significant influence. How do you assess a significant influence is something we're going to see in terms of Ind AS 28. But generally, when you look at a joint control, you can say a joint control could be, let's say, two parties with a 50-50. Nobody's got a control, but they jointly control. Let's say three parties with 1/3 voting power each. So when I say a significant influence, generally it would mean 20% or more voting power. But let me tell you that Ind AS has not got any ruled-based assessment. It is all a principle-based assessment. Your percentages cannot be a criteria in terms of deciding that there is a significant influence or not. So for the basic understanding, assume that the control comes when you get more than 50%. A significant influence comes when you get 20% or more. A joint control means two parties 50-50. But we'll see that later. And if not a significant influence, it could indicate that you're purely just a passive investor. Neither a control, nor a joint control, nor a significant influence. Now, one thing very clear, that if the answer is a no, then Ind AS 103 undoubtedly is not applicable. Because unless you get a control over the business, Ind AS 103 cannot trigger. So that standard is out. So which standards would apply in this particular case? We can say if it is a case of joint control, here again, you are required to make a separate and a consolidated financial statements again. Depending upon the relationship, mind the words, depending upon the relationship, there is a different consolidation standard applicable because the technique of consolidation is going to be different. Your relationship with people tells you to greet people with a different style. You would meet an elder and probably say namaste. You would meet your friend and you'll probably say hi or what's up. What's up? So the relationship would decide, consolidation would of course be done, but the type of consolidation varies according to the type of relationship. So when it is a joint control, the separate financial statement standard Ind AS 27 applies. And for the consolidated financial statements, Ind AS 111 would apply. That's called joint arrangements. I'm just giving you a feeler in terms of the various combinations and which standards would trigger so that you get a complete framework in terms of which combination triggers the application of which standards. A significant inference would again mean that I'm required to make a separate financial statements that is as per Ind AS 27. I'm also required to make a consolidated financial statements, but that would be as per Ind AS 28. And if you say that you're a passive investor, this means that it is less than 20. So as I said, a significant influence would generally mean 20% or more. A passive investment would mean less than 20%. Generally, a control would generally mean 50% or more. And a joint control, as I said, that there could be, let's say, an equal percentage of two parties. So this is the per se inputs. For a passive investor, Ind AS 27 is not applicable. If you're a passive investor, that means there is no relationship. The standard Ind AS 27 applies only when there is a related party relationship. Your subsidiary, in case of control, your joint ventures in terms of joint control, your associates in terms of significant influence. Ind AS 27 triggers only when you've got a related party relationship with the investee, a control, a joint control, or a significant influence. If you have got a passive investment less than 20%, Ind AS 27 doesn't trigger. And which standard would trigger in this case? Even the consolidated financial statements are not applicable. So let me make it clear that even the consolidated financial statements are not applicable. You just need to apply the instrument, the financial instrument standard, there is 109. The moment you acquire an investment in equity instruments, you know that it is a financial asset. And that would be, accounting will be governed using Ind AS 109. Either it's taken at FPTPL or it's taken at FPTOCI, depending upon the parameters. Okay. So far, so good. I guess the chain of thought must be pretty clear, but I think I still want to make the chain very clear. I'm just going to do the consolidation, but let me see if there are any questions coming in between so far, then we can take it. Okay. Thanks, Namrata. Viraj, you said, so brand acquisition is a single asset acquisition or a group of assets. Well, if you say that it is just acquisition of a brand, that's it, then I think per se it is a single asset. But don't worry, we're going to make you a walkthrough in terms of how to decide it's a business. No worries. Today, we're going to spend some good time creating a wonderful conceptual knowledge to you as well. Okay, so let me consolidate the picture. And in the meantime, let me know if this chain of thought is pretty clear or not. Just look at the entire 3-step and see that are you getting a clarity in terms of which combinations with standard would trigger. Let me just take a consolidation of this and then take it further. So as I read the definition of a business combination, the definition of a business combination is focusing that you need to get a control one over a business. So there are two key focus points that you need to get a control over a business. So one hand, I looked at the definition where the key focus is business and the word control. And then I also looked at the scope of the standard. So you need to read the definition of a business combination, and it is to be read along with the scope of the standard. So I showed you the scope of the standard, and very clearly Ind AS 103 scoped out two things. It says that if you acquire an asset, or if you acquire a group of asset which is not a business, then the business combination standard cannot apply. So with that help, I created a three-step model focusing on the scope and focusing on the definition. So looking at the scope and the definition, I made a three-step model. And in terms of the three-step model, I said, the first thing which you need to put across is, what did you acquire? Because one thing is very clear, that if you acquire a single asset, 103 scopes you out. So the moment you acquire a single asset, depending the nature is tangible or intangible, the given standards would apply. So you've got those individual standards on PPE 16, investment property 40, and intangible assets 38. Done. If you say it is a group of assets, we need to go to the step number 2, because the standard very clearly says that if the group of asset is not a business, then the standard doesn't get triggered. So if the group of asset is not a business, 103 doesn't apply, but still 103 gives you guidance. Now, how do we decide that whether it's a business or not? No worry, I'll explain that very shortly after this chain of thought. We'll work upon the concept that when do we call a group of assets as a business? So 103 is not applicable, but still we are given a guidance in the standard which tells you that you made a payment, a consolidated payment for a group of assets. So you need to allocate that consideration to the various assets. I'll take an example very shortly after this on that. So business is one focus, and doing an illustration on this is another. If you say, yes, it is a business, you go to the step number 3. And in terms of step number 3, you need to see that did you get a control over the business or not? If you say, yes, you get a control, you need to apply 103, which is a one-time application, along with which you're required to make 2 financial statements. One is a separate financials and one is a consolidated financials. Separate financials, Ind AS 27 triggers only when you invest in a related party. And the consolidation for a subsidiary when there is a control is 110. But if you say there is no control, then it could be either a case of a joint control or a case of significant influence, or maybe neither of them. So in these cases, Ind AS 103 100% is not applicable, but you would be required to make a separate and console, but that would be based on different standards. Ind AS 27 would apply for the separate financials only if there is a joint control and significant influence. Consolidations, you can see a different standard. And if there is neither a control, nor a joint control, nor a significant influence, then it is a pure passive investment. No separate financials, no consolidated financials. We just need to show the investments in the balance sheet as a financial asset, and Ind AS 109 would apply. I guess I am 100% clear so far, friends, at this stage. I guess you're absolutely comfortable with this. Okay, I think a few questions coming in. Namrata, you said step 1, what do you acquired a single asset? Okay, I think that was the answers coming in. Wow, that's great. That's great. Okay, so I guess everybody has been now very comfortable with my 3-step model in terms of which standard triggers when. Now let's go to the next phase. I guess let's have a look at a very simple question with you. So let me just take you to a very simple little question out here. Let's have a look at the question number 2, and this will give you an insight in terms of a group of asset which is not a business. So let's have a look at this. In question number 2, you can see it's written, an entity acquires an equipment and a patent. You're acquiring an equipment, you're acquiring a patent. Now, if you acquire an equipment and a patent, you cannot say that there are 2 assets, so it cannot be a business. We need to see that. So it is a group of assets comprising of 2 assets, an equipment and a patent. And it says it is acquired in exchange for 1,000 crores cash and land. So what the company did, they paid cash they gave land, and in return, they acquired a patent and equipment. Then he says the fair value of the land is 400 crores and the carrying value of the land is 100 crores. The fair values of the equipment and the patent is also given. It is 500 crores and 1000 crores respectively. So you are given the fair value of what you acquired, and you're also given the fair value of what you gave. Mind the words carefully. You know the fair value of what you gave, and you also know the fair value of what you acquired. Both the fair values are given. The equipment and patents relate to a product that has just recently been commercialized. The market for this product is still developing. They assume the entity incurred no transaction cost, and for the ease of convenience, the tax consequences on the gain is being ignored. How should the transaction be accounted for? Well, at the moment, since I've not given you any parameters that how do you decide it's a business or not, you'll come to know of it very shortly. But for the time being, just keep in mind that this cannot be. You'll come to know the logic very soon. But with the given facts, it cannot be a case of business acquisition for sure. Now, why it would not be a case of business acquisition, you will understand this once I come to the nitty-gritties of business. But it cannot be a case of business for sure. So let me put it outrightly that this is not a business. It's an acquisition of a group of assets, but not a business. Now, let me take a liberty of asking you a question. You might have done Index 16, and I think based on that, or maybe if you've not done Index 16, at least you have an idea on the IGAP Accounting Standard 10, and on that basis, you can answer me a small little question. When a company acquires an equipment and patent and they give a cash and land, so when you're going to record the value of patent and equipment, should you consider the fair value of what you gave, or do you consider the fair value of what you acquired, since it is a transaction of exchange? So we are saying that group of assets is going to be a case which is not a business. I need to trigger the Ind AS 16. So in this particular case, what will you consider? The fair value of what you gave, or will you record it at the fair value of what you receive? Your inputs. Let's see what answers are we going to get in this case. So what do you say that once I'm looking at this particular situation, that you acquired a patent and an equipment, in return you gave cash and land. So do we take the fair value of the land, that is what I gave, or do I consider the fair value of the patents and equipment for recording the acquisition? Okay, I think I'm going to get answers slowly and steadily on that. So I think let me give you the answer very clear. Well, I think in this particular case, we can undoubtedly say that there is definitely a commercial substance. And that's, I think, rightly, I got the answers. That's right. Absolutely. We got the answers, the fair value of what we gave. Absolutely wonderful. So we need to consider the fair value of what we gave. So coming back to the inputs out here, we can say that if I were to calculate what is the consideration which is paid, I would say we paid 1000 crores of cash and the fair value of the land is 400 crores. So the total consideration is going to be considered 400 crores. This is the total consideration which is paid, and this is to be allocated. This is to be allocated between the patent and the equipment in the ratio of the relative fair values. So I will now use the fair value that is 500 is to 1000 and pass the entry. Let's see what is the entry which is going to be. So we're going to put the entry that is equipment account debit. And we've also acquired a patent. So we will also consider the entry patent account debit. So this is going to be a total of 1400 crores divided in the ratio of 500 is to 1000, the ratio of the relative fair values. So we divide 1400 in the ratio of 1 is to 2. So this comes to 467. And this works out at 933. So 1400 crores divided in the ratio of the fair value, that's 500 and 1000. And we gave a cash. So give a credit to the cash to the extent of 1000. And we also gave a land, but land is going to be given a credit at a book value because you need to de-recognize the land at a book value. and the book value of the land is 100 crores. So naturally, there is a balancing figure, and that would mean that there is a gain or loss on exchange. It's a purely exchange transaction. So 1400 minus 1100, we're getting a balancing figure of 300 on the credit side. So that is a gain on exchange that gets a balancing figure 300. So this is a case where a group of assets were acquired, but it was not a business. Since it was not a business, Ind AS 103 would not trigger. But at the same time, we are basically applying the guidance given in Ind AS 103 that the consideration paid is allocated in the ratio of fair value. And since it's an exchange transaction, so it is resulting in a gain or loss, which will be taken in the profit and loss account. Simple and straight. Okay, so this part is done. Now, I've already given you the inputs in terms of that a group of asset is not a business. How would the allocation be done? Now comes the very crucial question, and that is, how do you decide the group of asset is supposed to be a business or not? So now we're going to work upon that, and now a little technicalities will start. Because as I'm going to explain you the concept of whether a group of asset is a business or not, this is slightly a complicated area. So get ready for some complexities at this stage, but trust me, you'll understand it very well. Because even in this particular case, I'm going to give you a 3-step model, which will illustrate to you that how do you decide that a group of asset is a business or not. Okay, let's begin the journey. So what I'm going to do, I'm going to first of all take you to the study material. And there is something very interesting which is given in the study mat. I think I'll have to just load it once again. Just give me a second. I'm just going to take you back on the study material, and let's have a look at a very interesting chart which is given in the study material, which illustrates that how do we make an assessment that it is a business or not. A very, very good chart is given in the study mat. So I'll just show you the chart. I'll illustrate the chart to you. But before that, we need to understand something more before the chart. I guess that I miss on this. This illustration which I did is also given in the study material as well. Okay, I think I might have loaded the old study mat, I guess. So, okay, just give me a second, I guess. I just need to load the new study mat to you. Just give me a second. So let me just download this from the section. So let's have a look at the standard Ind AS 103 study mat to you. So we get a little good inputs on that. Great. So let's have a look out here. We can now see in the study mat something very interesting given. Okay. So I think this would be visibly clear well enough. So there is a very interesting chart which is given out here. So I'll illustrate the chart to you. Well, this is the interesting chart. Okay, I guess friends, it's visibly clear. Just let me know if you can see the chart well. Is it clear enough to see? Right, is that visibly clear? I guess this is on page number 13.13 of the study mat, and I'm looking at this chart. I hope you can clearly see the chart, right? Okay, let's begin. Now, before I look at this chart, there's something which I need to tell you. The standard setters had one thing very clear in mind, and that was that, this kind of assessment could be time consuming, and it could at the same time involve a lot of judgment as well. So the standard setters decided that when you're deciding that a group of asset is a business or not, they gave a test which is called a concentration test. They gave a test which is called a concentration test, but this concentration test is supposed to be something which is purely optional. A company may decide that it wants to apply a concentration test, or it may decide, no, it does not want to apply a concentration test. So I would say, before you apply this particular chart, you need to first of all ask the company, are you interested in applying a optional test, which is called a concentration test? Now, before I take you to the chart, let me also get the chain of thought very clear. So just have a look at this. I'll just first take you to the chain of thought, and then we'll come back. So let's have a look first of all on the chain of thought. So the thought process goes something like this. The thought process would go something like this. At the first stage, there is an optional test. Please hear this chain very carefully. At the first instance, there is an optional test, and this is called a concentration test. This is called a concentration test. We will see how do we conduct a concentration test as well. So the standard setter said at the first instance, there is a complete option on the part of the company. Do you want to apply this concentration test? Now, the possibilities are, the company says, yes, I want to apply this test. The company says, no, I don't want to apply this test, because it's an option. So the company may decide, yes, I'm applying the test, or it may decide, no, I'm not applying the test. If the company says, no, it is not applying the test, then you can say, I'm going to apply the three-step model, which I'm going to create on the basis of the chart, which I just showed you. So I'm going to basically apply the chart, which I'm going to convert into a three-step model, and we are going to see that how the three-step model works. Okay. If the company applies the optional test, then we need to see what is the result of this test. Did you pass this test, or did you fail this test? We don't know what is a concentration test, but for the time being, either you pass the test or you fail the test. So you choose to apply the test and you pass the test. If you pass this particular test, then we lead to a conclusion that it's not a business. Then we lead to a conclusion that it is not a business. And if you fail this particular test, you need to again apply the three-step model. So the chain is very simple. So I'm now working on the concept that when a group of asset is acquired, you need to see that is it a business or not. So in order to decide whether a group of asset is a business or not, you can say this is the basic chain of thought. The company has to take a call whether they are interested in applying an optional test called a concentration test. Now, what is a concentration test? Don't get worried on that. We will understand that. So the standard setters decided that let's give an option to the company. Do you want to apply a concentration test? Now, एक बार जो commitment कर दी, उसके बाद आप अपने आप की भी नहीं सुन सकते. So if you choose to apply a concentration test and you pass the test, then in that particular case, you will say it's not a business. Done. You cannot apply the three-step model if the concentration test passes. Mind it very carefully. If you pass the concentration test, you've concluded it's not a business, you cannot go to the three-step model. So there are two situations where a three-step model would apply. You apply the test and you fail the test, or you choose not to apply the test, then you need to apply a three-step model. That's one. Second, another thing, let me just also give you before I take you to the chart, and that is, when you apply a three-step model, we need to consider something at the background, and that is, when you look at a business, when you say that group of asset is a business, we need to understand that business has got a total of three elements. We need to understand that business has got a total of three elements. One of the elements is called input. The other element is called a process. And the third element is what is called output. So we need to understand that when you evaluate using a three-step model, there are a total of three elements in a business. One is called input, one is called a process, and one is called an output. Let's take a simple example to understand what is an input, what is a process, and what is an output. For example, let's say there is a company which is manufacturing cars. So it has got a raw material, which is supposed to be an input. And that raw material is going to be converted into a finished goods, that is a car, which is supposed to be an output which they sell. The revenue is the output. The car is the output. So converting this input into output is using some kind of a technique, and that is called a process, some kind of a formula. So for example, if you consider any business for that matter, let's consider that a company is producing, let's say Coke, they're producing Pepsi. So they're converting the raw material, which is input, into an output, and that input into output would be converted using a particular formula, and that is a technique which is called a process. So when you say that you acquired a business, on the very forefront, on the very apparent level, you need to consider that did you acquire the inputs, process, and the output? The three elements are present. So apparently we can say, yes, it is a business. And we have to talk about the concentration test. Don't worry, we'll talk of that. So what does a company do when it needs to decide that they acquired a group of assets? I will first of all go to them and ask them that, okay, are you interested in applying the concentration test? They say no. Then I'll say, okay, you apply the three-step model. They say, yes, we apply the concentration test, and they pass the test. I'll tell them it's not a business, and I'll say it's the end of the story. They apply the concentration test and they fail that particular test, then I'll say, okay, I need to conduct a three-step model in this case. So before we understand the three-step model, this is not three-step. This is not three-step. These are just three elements before we understand the three-step. So on a very basic level, when you say that you acquired a business, there should be a presence of three elements. One is called input, one is called process, and one is called output. Now, one thing more I'd like to clarify. You know, when I say a process, remember one thing, that if a company has got an organized workforce, when I say organized workforce, I'm not talking of people who are in the admin department. I'm not talking of people who might be in the sales and the marketing department. The organized workforce is basically those people who have the necessary skills and knowledge, with the help of which the input is going to be converted into output. Like, for example, if I'm in a liquor industry, and I would say that, you know, those people have the real knowledge of the process with which the liquor is made. So the organized workforce is considered to be a process, and it is also an input. So there is one thing which is common. Input per se would mean raw materials, equipments, building, land, etc. But even an organized workforce, the labor is going to be an input, but that labor needs to be an organized workforce, somebody who's got specialized knowledge of knowing the skills of converting the input to output. And the organized workforce is also going to be a process as well. So let me make a mention that when I'm looking in terms of the input, remember the golden rule that there is one thing which is both an input and process, and that is an organized workforce. That is what you call an organized workforce. So what I'm going to do at the first instance, I will first explain the three-step model to you. And then I'm going to explain you the concentration test, because concentration test is slightly more mathematical in nature. And I need some time to explain the logic to you. So what I'm going to do, first I'll explain the three-step model with these elements. And then I'll explain the concentration test to you with good number of examples, and you will be able to get the edge in terms of understanding when is it a business or not. So let's begin. So I guess what I'm going to do, I'm going to first of all take you back on the study material, and let's have a look at the study material, the chart which is given. Let's have a look. Now, don't worry on the notes. First of all, just hear me carefully, because this is going to be slightly complicated. And I know unless I do some case studies with you, you may not be able to get a clear-cut image. Don't worry. I'll take a few case studies, also 1 or 2 case studies to give you a clarity. But first, let's understand the concept. So I'm going to slowly also convert this into a 3-step model as well. So we'll see how we're going to convert this in terms of a 3-step model also. Okay, so let's, I think, begin the journey in this case. You can see, first of all, this part of the chart, which says we acquired inputs and processes. As I said, there are 3 elements. Please hear me very carefully. The next 10-15 minutes is going to be very crucial. Either you get the concept or you don't get the concept. 99.99% you will get the concept. If you hear me properly, terms and conditions apply. So next 10-15 minutes, very crucial. So as I said, that there are a total of 3 elements in a business. One is input, one is process, and one is output. Now, in step number 1, you just need to put across a question that did you acquire inputs and process? I'm not worried whether you acquired the output or not, because sometimes you may acquire a company which is a startup company, and the startup company may not have actually started operations, and there may be no revenue. So when I say that there is no revenue, it means there is no output. The presence of a revenue means the presence of an output, and the absence of a revenue would mean the absence of an output. So in the step number 1, at the first stage in step number 1, what do you need to do? You need to basically ask yourself a question. Did I acquire the inputs and the process? Reading a case study, I would come to know, okay, did I acquire the inputs and process? What is input? Raw material, building, land, equipment, everything. That's all your inputs. What is a process? A formula to convert. The organized workforce which is there. So we need to see that did you acquire the processes in terms of organized workforce or in terms of certain formulas with the help of which you convert into output. So we are only concerned with input and output. So the answer is either a yes or the answer is either a no. So step number 1, the chain of thought. Did we acquire input and process? So the answer is yes. If the answer is yes, I'll go to step number 2. If the answer is no, it cannot be a business done. It's an asset acquisition. So if the answer is a no, when I say go to A means it is an asset acquisition and B means it is a business. So step number 1, don't worry, we'll see the case studies also, but get the clarity. What do you need to put yourself a question? So in step number 1, you got to only put across a question, did we acquire input and process? If you say no, it cannot be a business. If you say by acquired only inputs without any processes, it cannot be business. So if you say yes, then I go to step number 2. Then I go to the step number 2. Now, in step number 2, we'll focus on the third element of the business, which is the output. We will say, okay, on the acquisition date, does the entity have an output or not? So you need to put across a question whether output is existing on the acquisition date or not. So you will either get an answer yes, or you will either get the answer no. There are different parameters for evaluation if the output is present, and there is a different evaluation parameters if the output is not present. So I would say, let's go safe. So in step number 2, you just need to see that the output is present or not. Whether the answer is a yes or no, you go to the step number 3. You go to the step number 3 irrespective. In step 3, we'll take care of two things: that if the output is there, what do we do? If the output is not there, what do we do? I hope the chain is very clear. So you need to first of all go in step number 1. Did you acquire input and process? No, not a business asset. Yes, go to step 2. Is there output present on the acquisition date? Yes or no, but still go to the step number 3. So step 2, you just need to see that there is an output or not, which will be very apparent in the question. Though we do not get questions in exams, there will be no questions in the exams where the examiner would ask you to make an assessment that whether it's a business or not, but at least you need to understand the dynamics. You cannot just go in the examination without even understanding, how do we identify that it's a business or not. Now, if I say, yes, there is an output, we go to the step number 3 and let's see what is given. Now, let's see what is given. I would say if the output is present on the date of acquisition, that means the company is already earning a revenue on the date of acquisition. The standard setters have been, less stringent in terms of evaluation. I'm just giving you a chain of thought. If the output is not present on the acquisition date, they've been more stringent in evaluation. So if a company has got output, it has got a revenue, the evaluation parameters are not very hard. But if you look at that they've got no output, then it is very important to evaluate that the processes will be able to generate an output. The presence of an output is, a good indication. So we don't need too much harsh evaluation. But if there is no output present, then the evaluation becomes slightly harder. So you will see that when the output is not present, then the evaluation is a little more stronger. There are more parameters which requires to be evaluated. So let's consider if there is no output. Let's consider if there is no output. It says whether it is critical. It means we're looking at the processes are critical. So you need to put across a question, is the process critical? Now you would say, how would I make a decision? Well, it could be a judgment. We're not getting into those nitty-gritties, but you need to put across a question whether the process is critical to the ability to develop or convert the inputs into output. I just need to put a simple question. Is the process critical? It is something, without which we cannot survive. It is critical in nature. That's question number 1. And you go to the question number 2, you'll see whether the inputs inquired includes both an organized workforce and includes other inputs the workforce would need. So there will be a total of 3 questions which you are going to put across. Get the questions clear? If there is no output, you will put across a question, is the process critical? 1. Did you acquire an organized workforce? 2. Did you acquire other inputs other than the organized workforce? The organized workforce definitely is an input as well as a process. And along with it, you should have also acquired other inputs as well, other than the organized workforce. So the questions are very simple. Let's get the questions clear. If you say that there is no output which is present on the date of acquisition, I'll say, okay, let me put across a total of 3 questions to myself. And I'll say question number 1, is the process critical? I said, yes. I said, did you acquire an organized workforce? I said, yes. I said, did you acquire other inputs as well? I said, yes. If all three are a yes, if all 3 is supposed to be a yes, then it is supposed to be a business. Because if all 3 are yes, then it is a business. If any one of them fails, it is supposed to be an asset acquisition. You need to meet all 3 questions. Anyone fails, it's not a business, it's asset. All 3 conditions are met, it is supposed to be a business. Okay, now let's come back. If I say that the output is present, in this particular case, the standard gave you 2 set of conditions. If there is an output which is present on the acquisition date, the standard gave you 2 set of conditions, 2 block of conditions. They said you meet block 1, you meet block 2, meet just one of the blocks. So you need to meet the block 1 or you need to meet the block 2. You just meet any one of them, it's a business. You meet any one of them, it's a business. Let's see the block 1. Whether it is critical to the ability to continue producing outputs, it says, and the inputs acquired, and the input acquired include an organized, experienced workforce. There are two questions. In step number 1, there are two questions. Number 1, is the process critical? Number 2, did you acquire an organized workforce? If you notice, the two questions are common. Here also we said that it is critical, organized workforce, but there is no third condition that other inputs have been required. So you can see that the conditions are almost quite similar. The non-presence of an output means 3 questions: critical, organized workforce, other inputs. The presence of an output means only 2 questions: critical and organized workforce. This is block 1. Or the block 2, the process acquired is unique, scarce, or it cannot be replaced. Just prove me one thing, that the process is something which is unique, it is something which is scarce, or is something which cannot be replaced. Just prove me this one condition, then in this particular case, I'll say it is a business. Let's get the chain very clear now. Let's create a 3-step model, and then we'll do some case studies, but let's get the clarity based on the 3-step model. So on this basis, let me just come back out here. Let me just take you back on the notes. So let me see if there are any questions coming in between. I know we are discussing something very technical indeed. Okay, I think Namrata said, if a company apply a 3-step model and it get results other than which they want, then they can apply a concentration test. That result can consider. Well, if you fail a concentration test, then only a 3-step model could apply. Yes, I'll give you examples. No worry. We're just going to come to the case studies very soon on this. No worry. No worry. So let me do one thing. Let me first of all take you to the chain of thought in terms of the 3-step model. We'll come to the concentration test after this, but let's first get the clarity in terms of the 3-step model. So I am giving you that how do you identify it's a business? And for this, I'm giving you a 3-step model, which will make life very simple. We'll take case studies immediately after this 3-step model is done. Then we're going to come to the concentration test as well. So what I'm going to do in terms of step number 1, I will first of all see, did we acquire? I will first of all see, did we acquire both? So the focus is, did we acquire both input and process? Underline the word input and process. So this is the first question which you're going to put across to yourself, that did we acquire both input and process? So when I say input, input would mean your land, your building, your equipment, your raw material, anything which is, basically assets. They are basically inputs. Your labor, your material, they're all supposed to be inputs. So the answer is going to be either a yes. The answer is either a yes or the answer is a no. If you say no, I did not acquire a process, the basic question is that you need to acquire a process. If the answer is no, I only acquired inputs but not process, it cannot be a business. It cannot be a business in this particular case, then it is supposed to be asset. When I say it's not a business, it is supposed to be an asset acquisition. So it cannot be a business, rather we can say it is an asset acquisition. But if the answer is a yes, I'm going to go to the step number 2. So this is going to be pretty simple. I don't see much challenge in terms of the step number 1. So step number 1 is not going to pose any challenge. You just need to see that did you acquire a process or not. Output is not the concern. So let me clearly mention that in step number 1, you are not concerned with output. The presence of a revenue, which is output, is there or not, is not the concern in step number 1. Then we go to the step number 2, and in terms of the step number 2, In terms of the step number 2, we will say that is there an output, and let's put a square against the word output. That's the key word. So is there an output present on date of acquisition? So the date of acquisition is the focus. So let me underline date of acquisition. So we need to see that there is an output. And how do you see that there is an output? Output would indirectly mean you need to see the presence of revenue. Is the company earning a revenue or not? So you need to see that is the company earning a revenue or not. So is there an output present on the date of acquisition? The answer could be a yes, or the answer could be a no. Irrespective, I will go to the step number 3. So in step number 2, you just need to see the presence of revenue. You just need to see the presence of revenue. That revenue implies an output. So the output is present or it is not present. Okay. Then we go to the step number 3. Then we go to the step number 3. So I made your life very simple, giving you 3-step models at the start, another 3-step model for the business. So it's very easy because this is a complicated standard. So going on a step-by-step is going to be interesting. I've divided this entire standard application into a total 7 steps. You're going to see later, the acquisition accounting is something I've developed into a 7-step model. So you know at each step what is to be done. So even when you're doing the larger, bigger questions, it's going to be very easy to tackle them. So in terms of step number 3, I'll just make a chart. So we just make a simple chart out here. And in this particular case, we can make a chart, and the chart is on the basis that the output is not there or the output is there. So you've identified that the output is present or the output is not present. So what we're going to do, if you say that the output is not present, then in this particular case, you've got 3 parameters. I'm just putting the critical words to you. So there are 3 parameters. All need to be met. All need to be met for qualifying as a business. All need to be met for qualifying as a business. So you need to meet all the 3 parameters if the output is not present. And if you meet all 3, it's a business. Otherwise, it's going to be an asset acquisition. So what are the 3 main parameters? Number 1, the process is critical. The process is critical. So this is 1 parameter plus number 2. Organized workforce has been acquired. So underline the word organized workforce has been acquired. So this is the second parameter which you need to meet, that organized workforce has been acquired. And number 3, we need to put across that other inputs other than the organized workforce. So let's underline other inputs have been acquired. So you need to see that you've acquired not only the organized workforce, but also the other inputs as well. So these 3 conditions need to be met. Any one fails, it's an asset. So let's put it like this, that in this case, any one fails. Any one fails, then in this particular case, it would be regarded as an asset acquisition and not a business combination. So you need to meet all 3 conditions. Let's get the chain clear. Okay, then further, if I'm looking in terms of that output is present, then there is block 1 and there is a block 2. So I would say there is a block 1 or block 2. You need to meet any one. You need to meet any one of the blocks. So if the output is present, you've got 2 blocks in this case. You need to meet any one of the blocks. And the first block is got 2 parameters. The first block is got 2 parameters, and you need to meet both the parameters. And you can say it is the same. The process is critical. So it is the same parameter. The process is critical. Let's underline the focus is that the process is critical. Same. Second one is also the same, that there is organized workforce. The organized workforce is being acquired. So two parameters are common. The third one is not there. Or there is a block number 2, which has got only one parameter. That has got only one parameter, and that parameter is that the process is unique. The process is something which is either unique or it is scarce, or it cannot be replaced, or it cannot be replaced easily without making much efforts. So it's either unique, scarce, or it cannot be replaced. So this is the main parameters to be kept in mind. I've given you the key inputs in terms of taking a call. So I think let's consolidate this picture once again and take some case studies to make it even more stronger. I'm not yet given you a concentration test. I've just given you the inputs on the 3 elements, what is called my 3-step model. Let's take a run through of this model with you. Let me see if you have any questions coming so far. Okay, and I think a number of you said, can we apply a 3-step model first and then a concentration test? No. You need to apply, if, okay, you mean to say that, okay, I think the question is back again out here. Let me, start from here. Now let's get the chain of thought very, very clear. When a company acquires a group of assets, before you apply the 3-step model, you need to ask the company, please hear this carefully, you need to ask the company, are you interested in applying the concentration test? If they refuse, you go to the 3-step model, right? So when a company acquires a group of assets and you are evaluating whether it's a business or not, you put across a question to the company, are you interested in applying an optional test called a concentration test? They say no, you directly apply a 3-step model. Because they may choose not to apply a concentration test, then they will directly go to the 3-step model. Yes. Next. If they say, yes, we want to apply the test, you'll make them aware that if you pass this test, boss, you cannot apply a 3-step model. Because if you pass this particular test, then it, then it is not supposed to be an asset. It's not supposed to be a business. So if they say, yes, we are interested in applying a concentration test, you make them aware that if you pass it, it's not a business, you will not be able to apply a 3-step model in that case. But if you fail it, then you need to go through the 3-step model again. So there are 3 permutation combinations only. You decide not to apply, go to the 3-step model directly. You apply and you pass the test, then it's not a business, we're done. You apply the 3-step model, as you apply the concentration test, you fail, you need to apply the 3-step model, right? I guess your question gets answered on that, right? Okay, means first preference is to concentration test. Yes, you can say that. You need to ask the person that, do you need to apply a concentration test? If they do, and then it depends upon the pass or fail. If they don't want to do it, it's a choice, then you go to the 3-step model. But you cannot ignore the concentration test. Ignore in the sense that you've chosen not to apply. That's as good as ignored. Okay. Now, coming to the 3-step model, we'll come to the concentration test later. Now, coming to the 3-step model, it's a simple concept. You need to focus that business has got 3 elements: input, process, output. Fairly, we've understood what is an input. Input is like raw material, your land, your buildings, equipment, etc., your organized workforce. They're all supposed to be inputs. The process is you can say the technique with which the input is going to be converted into output. And the output is nothing but, you can say, as good as revenue. If you're already running the business, you have a revenue, you've got an output. Finished goods, revenue indicates output. In step number 1, the focus is only 2 elements, input and process, not the output. I'm not worried on the presence of output. So if the input is acquired but the process is not, cannot be a business, asset acquisition. You acquired input and process. Okay. Then you go to the step number 2 and just see that revenue is present on the acquisition date, which means output is present on the acquisition date. If you say yes or no, you still go to step number 3. Basically, what we're doing in step number 3 is understanding that the processes are substantive in nature. If you technically ask me what I'm doing in terms of step number 3, I'm basically evaluating that the processes acquired. So are the processes substantive or not? Have you acquired the processes? And that is something which is substantive. So you have got two set of inputs, two set of things. The output is not there on the acquisition date. The output is there. So remember, the easy way to remember is that if there is no output, the rules are more block 2. The two conditions are same: critical, organized workforce. Or prove it to me that the process is unique, or it is scarce, or is something which you cannot replace. Right? I guess, friends, the chain of thought is pretty much clear at this stage. Then I think we can take you to more questions. Rahul, so dear sir, are you going to solve the previous examination questions also eagerly waiting? Of course, of course. Okay, you mean to say that are we going to get some practice sessions or something where we're going to concentrate purely in terms of doing some questions and answers, something which you had, something like financial instruments, which I saw that you wanting me to do some practice sessions after the concept part is done? Maybe we can plan for that. I don't know. But as of now, we're going to first cover up the concepts with some questions and all, and then maybe it can be planned. And number two, why we consider the output on the acquisition date? Because the date of acquisition is the date when you're going to decide that Ind AS 103 would apply or not. So it is on the acquisition date you need to decide that the standard is getting triggered or not. Right? Okay. So I guess so far so good. You've been, just give me the inputs so that I can convert your inputs into output. Have we understood the thought process of evaluation of business? Are we ready to take you to some case studies on this? So I think let me just take you to the case studies on this. I'm just going to add a few application case studies. We're just going to pick up one or two case studies with you, not too many, but just to get a little flair of things. Okay. I think I got an answer yes, one answer yes on that. I was expecting more answers to come in. So are we ready to go with the case studies? Are you clear with the thought processes on the 3-step model of identifying the business? Right? Okay, so far so good. Let's begin the journey. I'm going to do a few questions with you just to give you a conceptual clarity without getting into too many nitty-gritties. So this is the examples, because this was a recent amendment in the last year. So I've given them examples to elaborate the amendment. Let's have a look. So let's have a look. Just see this carefully. And I've not given you the concentration. And thank you, like you took previous exam questions while teaching the concepts of Ind AS 115 last time. Of course, undoubtedly, yes, we'll do that, Rahul, of course. Okay, now in this particular case, the question is asking about a concentration test. I am now going to give you a very simple fact about a concentration test. I'll explain the concentration test in detail later, but I'm just giving you a very simple input about a concentration test. Let's look at an example. A company acquired, let's say, 3 assets ABC. A company acquired, let's say, 3 assets ABC. Now, what does a concentration test mean? I paid a total of 200 crores to acquire all the 3. I paid a total of 200 crores to acquire all the 3 assets. I came to know that the value of A is to the extent of 190 crores. The value of B is to the extent of 5 crores, and the value of asset C is also to the extent of 5 crores. I'm just explaining a very basic input about a concentration test. Let me ask you something. I paid a total of 200 crores to acquire 3 assets. Is my consideration concentrated substantially in a particular asset? Say a yes or no. Is my consideration concentrated in one asset substantially. 95% of the total consideration is paid for the asset A. If you look at the mathematics, 95% of the total consideration out of 200 crores, 95%, a substantial amount is paid only for one asset. If this be the case, it cannot be a business. This is what apparently a concentration test means, but there is more to it. There is a wonderful example given in the study material which illustrates the concept of concentration test in a detail. We'll come to that later. But for the time being, I'm just telling you what a concentration test means. A concentration test means that you need to see that is the amount of consideration concentrated in a particular asset. So is the fair value of a particular asset substantially equal to the consideration? The fair value of a particular asset is substantially equal to the total consideration. If this be the case, your consideration is concentrated in a particular asset. It's an asset acquisition and not a business. So just keep that in mind. And I think let's read it further. Now let's read it further. Now we're going to look at the case study number 1. Have a look. Watch me on my 3-step model carefully. I'll take 1 or 2 examples to illustrate the concept. It says an entity sells its radio broadcasting assets. I don't think so. I need to overemphasize the plural word assets. It says an entity sells its radio broadcasting assets to another entity. The acquired set of assets, activities and assets comprise of a broadcasting license, a broadcasting equipment, and a broadcasting studio. So there is a license, intangible, equipment, tangible, and a studio, tangible. But there are 3 assets. So it is a group of assets. At the acquisition date, the fair value of each of the assets sold is considered similar. I want to ask you something, friends, and I think you can vouch me. If you acquired 3 assets and the fair value of all the assets are similar, do you think the consideration is concentrated in any particular asset? You can think about it and send me your answers on that. What do you say? Do you think in this particular case, the consideration is concentrated in a particular asset? No, they're equal in value, 1/3, 1/3, 1/3 each. So considering that the values are similar, I think none of the value of the asset is concentrated. So it cannot be. It cannot pass a concentration test. See what it says. Identify if the transaction is asset or business in case the entity decides to apply the optional concentration test. So in this case, if you apply the optional concentration test, I can definitely say it will fail, because the fair value of each asset is equal. So the fair value is not, the consideration is not concentrated in any particular asset. Then he says no processes needed to broadcast the radio shows are sold. There are no employees or other assets, activities or processes included. Entity S has stopped using the acquired set of activities and assets before they sold it to R. I don't think so. I need to answer that question. You can easily tell me. I'll go to my 3-step model and let me apply the step number 1 itself. Do you think you acquired both an input and process? I think you can tell me the answer, yes or no. I don't think so. I need to give you any answer on that. He's very clearly telling you no processes needed to acquire or taken, no employees, nothing. No employees means not even an organized workforce, which I could have considered to be a process. And did not acquire any process, any organized workforce. So if the answer is a no, it is undoubtedly a case of an asset acquisition, simple and straight. Right, that's great. Wonderful indeed. The step 1 itself fails. That's right, Koshki. Pretty simple and straight. Let's take another example with you. So I guess let's go to another one with you. Let's take a little simpler one. I think somebody asked me about a brand. Somebody was asking me about a brand, and I said, yes, we'll come to an example with you. So let's do one thing. Let me just clear this and let's talk about the brand with you. Okay, so let's have a look at the example number 3. So let me read this and we could apply this out here. That's perfectly correct. I think everybody's reached a good conclusion. Wow. Okay. It says an entity B purchases from another entity the worldwide rights to product 1 to 3, including all related intellectual property. In addition, so you made a purchase of worldwide rights, including all the IP. In addition, you've also purchased existing customer contracts and customer relationships, inventories of finished goods, customer incentive programs, raw material supply contracts, a lot of intangibles, specialized equipment specific to manufacturing product 1 to 3, documented manufacturing processes and protocols to produce 1 to 3, a group of assets. We require a huge group of assets comprising of a couple of things. Entity B does not acquire any employees, other assets, other processes, or other activities. Used to apply the optional concentration test, we definitely know it will fail. I want you to decide now, do you think it is a business if you would apply the step number 1 and ask yourself that did we acquire the inputs and the process? I think that be your call. In this particular case, he very clearly makes a mention that B does not acquire any employees. That means no organized workforce or any other processes. No processes, no organized workforce. I feel the step number 1 directly. The processes has not been acquired, and that's right. It is again, the answer is a no. So this means it is undoubtedly an asset acquisition. Right? I think I've given you a very basic example. But you would say, sir, please, let's take an example, where we enter at least a step number 3, right? Because we've taken an example where the step 1 fails and the end of the story. Can you take an example where we reach a step number 3 at least? Okay, let's do that. Let's do that. Let's, I think, take a wonderful illustration further with you. And I think let's have a look. So this is again interesting. Let's have a look at this one. So we will get answers from you. Okay, that's wonderful. I think that's right, Janvi. That's right, Rahul. That's right, Namrata. Wonderful. The answers pretty well. Okay, now let's go to the example number 4. An entity D acquires a legal entity that has a rights to a research and development project that is in progress of its final testing phase and to develop a drug to treat pneumonia. It's called a development asset. The development asset is including the underlying knowledge, the formula, the designs and protocols expected to be complete this phase. And then he says a contract that provides outsourcing of clinical trials. The contract does not state which vendor should be used. There are several vendors that could provide these services, and the contract uses current market price. Therefore, the contract has got a 0 fair value. They've acquired 2 things, mind you. Let me make it very clear so that the job becomes simple. They've acquired 2 things in simple words. Number 1, they've acquired something, they're calling it as a development asset. Number 2, they've acquired something which has got a 0 fair value. And there is no option to renew, blah, blah, blah. Entity D has not acquired any employees, other assets and other processes or other activities. I think, let me see this and ask you something. Did you acquire a group of assets in this case? Or do you think you acquired just a single asset? Mind it, you've acquired a development asset. You've acquired some clinical trials, which has got a 0 fair value. So do you think you really acquired a group of assets, or do you think it is a single asset where the entire amount is concentrated in a single asset itself? So when you go to apply the optional concentration test, can I say the entire consideration is concentrated in the development asset? What do you say, yes or no? In this particular case, considering that there is a development asset and there is another asset, but it has got a zero fair value, and that's right. I think it's outrightly a case of a single asset itself. And if it is a single asset, I don't think so. I'm even thinking of applying a three-step business model. Simple and straight. Somebody you said you're going to take an example where the output is going to be present or something, but you've taken simple examples where the concentration test fails and directly you say that there are no processes or the single asset is case. Take a better case study. Okay, so let's take a better case study with you. Let's, I think, take a case study number 2. So let me take you to the example number 2. So let me just clear this, and I think let's take your call on this. Okay, just a second. Let me just play. Oh. Just give me a second. Let me clear this. Then I think let's consider the example number 2. And this will complete the three-step model. Then we need to talk in terms of the concentration test. Okay, so far so good. Let's, I think, take it further. Now we're looking at example number 2. It says entity A purchases another legal entity, which is a solar cell. Entity solar cell carries out research and development activities on several solar projects that is involved in and are currently in progress. It has got scientists who possess the skills and knowledge and experience needed to perform these activities. You've taken over these scientists as well, and I believe these scientists are supposed to be both an organized workforce, which is an input and a process. Then he says it has also got tangible assets, which include a lab equipment and a factory and laboratory to perform such activity. Currently, the product is not ready to be marketed, and there has been no sales. That means no output, no revenue has been made. All the assets acquired are deemed individually to have a similar fair value. I think this makes a little more sense. So the facts are very clear. You've acquired a couple of assets with you, where you've acquired a lab equipment, a factory, laboratory, along with scientists and all. And he says the output is not there. We don't got any sales so far. And the value of these assets equally got a similar fair value. Identify the transaction is an asset or business if you decide to apply the optional concentration test. Now let's go with you on this. And I think I've already got started getting answers on that. First of all, let's see the optional concentration test. Do you think I'm going to pass or do you think I'm going to fail? When I know that the individual assets have got a similar value, which means that the consideration is not concentrated in terms of any single asset. And if that be the case, I think the concentration test should 100% fail. So we need to apply the steps. Say that, is there an output which is present? And I said, no, there is no output which is present. There is no output which is present. Okay, the video is getting paused, or maybe that's an internet issue at your end. You just have to take a refresh. So the output is not present. So I go to the step number 3. If the output is not present, quickly, 2 blocks, or is it 3 parameters? We decided that if the output is not present, we are a little more stringent in terms of evaluation. So there are a total of 3 parameters to be met. And in this particular case, let's see the parameter number 1. Is the process critical? I guess considering that you're into research and development of solar projects where you need scientists and all, I think the process is definitely critical in nature. Did you acquire the organized workforce? Yes. I definitely acquired the organized workforce as well. And did you acquire the other inputs also? Yes, I acquired the laboratory, the factory, etc. as well. So in this particular case, it's a yes all throughout. Therefore, we can say it is undoubtedly a business in this case. Okay, I think we got some inputs. There is an input and process, but not output present on the date of acquisition. Great process critical, acquisition organized workforce, and other inputs superb. So I think you would have got a fair idea, though in the examination, we don't get questions on this nature, where you're given subjective case studies of evaluating whether it's a business or not, but still, when you're studying a particular standard, it is very necessary to get the conceptual understanding clear. So far, what I have covered with you, friends, is number one, two three-step models with you. One is a three-step model which gave you a fair idea that which standard is going to trigger. What did you acquire? And if you acquired a group of asset, was it a business? And if yes, then which standards would trigger? And if not, then which standards would trigger? Then I gave you the concept of a business, which I again gave you a three-step model in terms of understanding that in this particular case, process is the key focus in step one. And then looking at the presence of output or not, and accordingly deciding the parameters on the basis of which you decide it's a business. But now we also need to understand the optional concentration test in a little more detail. But I think before that, I think we should give you a break as well. What do you say? I think it's the right time to give you some break as well. I'm sure the mind is getting a little tired, but before we take a break, friends, with you, I just want to get your comfort zone on a scale of 10. If you were to give your comfort zone on a scale of 10 on your understanding on the two three-step models, identifying the combination of standards, and identifying that whether it's a business using a three-step model, I want to see what is your comfort zone in terms of your understanding on a scale of 10. Okay, Namrata gives me 9. That's pretty good. Koshki says a 10 out of 10. That's wonderful indeed. And what do my other friends got to say on this? Okay, I think maybe the answer sometimes comes a little slow on that, but I think so far so good. We've got 2 scores on that, which is quite encouraging indeed. So I think on that note, I think first let's give you a break. Then after that, I'm going to discuss first of all with you the optional concentration test. And Raul says a 10 on 10, so you are the best as far as FR is concerned. Thank you, Raul. That makes my day. Thank you so much for the kind words. So I think let's take a break, friends, and then we'll join you back in 10 to 12 minutes time. Welcome back, friends. So I guess you had your mind relaxed as well for another little technical inputs, and we're going to discuss the optional concentration test with you. And let's take an example to understand the concept of an optional concentration test. And let me also see in the meantime if there are any questions coming at your mind. Okay, I think so far so good. No more questions so far. Okay. So let me now take you on the concentration test, for which I'm going to take you to the study material. And there is a wonderful illustration which is given in the study mat, which illustrates the concept of a concentration test. Okay, let me just take you to an example. This is a wonderful example which is given on a concentration test. Let me just zoom it further. I'll explain the logics as well, because we need to understand the concept, that what is the logic in terms of the concentration test. Now, first of all, just look at the technique. And once the technique is clear, I'll give you the logic as well, because understanding the logic is going to be different. So first, let's look at the technique, that this is what you need to do in order to do a concentration test. To make your life simple again, what I'm going to do, I'm going to create a 3-step model on concentration test. Oh my God. So we've got three-step models for the day. So we've got one to identify with standard triggers. One is for the 3-step business model test. And even on the concentration test, we're going to look at a total of 3 steps. Now, let's have a look. Let's take an example to understand this bit. Now, at the first instance, I am given, it says, let me just, let me just read it once again to you. It says entity A holds a 20% interest in entity B. So it says that entity A has got a total of 20% interest in entity B. Subsequently, it further acquires a 50% share by paying a total of 300 crores. Now, let's get one thing very clear. This company A already had a certain stake, and then they acquired a further stake. When they had already a stake, it was merely 20%, which gave them a significant influence. And then they acquired another 50% stake, and then it got converted from a significant influence, you can say, to a case of control. Because as we saw apparently, if you've got a 20% or more, it is a significant influence provided it is below 50. And the moment it turns more than 50, we would say it's a control. So this company already had a 20% stake, and then they further acquired another 50% stake, that makes it 70. Now, let's understand another thing. You know, if you've got a 70% stake in the company, you've got a control, and that is called a controlling interest. And the remaining 30% is with some other investors who do not have a control, and they are technically called in Indies as a non-controlling interest. That is called NCI in short. I put it again. As an investor, you've got a 70% stake in the company, which means you've got a controlling interest. The remaining 30% belongs to the other investors who do not have a control. So that is called a non-controlling interest. So we can say that you already had a 20% stake. Now, let me call this like this. This 20% is what I called PHI. Mind the words carefully. This is what we call a previously held interest. 20% which you already held is called a PHI. There is a previously held interest. And you've acquired another 50%, makes it 70. So we said the remaining 30% belongs to the NCI. Okay, so this is one thing. Let's read further. It says the fair value of the assets acquired and the liabilities assumed are as under. So we've acquired a building, a cash equivalent, a financial liabilities, and a deferred tax liability. So we give the list of all the assets and liabilities which has been acquired. Then he says the fair value of the entity B is 400 crores. And the fair value of the NCI is supposed to be 120 crores, which is nothing but the business valuation 400 crores into 30%, because that belongs to the NCI. So 400 into 30% will give you a total of 120 crores. The fair value of the entity's previously held interest, as I said, PHI, is supposed to be 20%, that is 80 crores. So what is done? He's given the fair valuation of the entity, and on that basis, he's taken the fair value of the PHI and the fair value of the NCI. So you've got three components. You've got three components. 20%, which is a PHI, he gives you a fair value of that. You've got a 30% NCI, he gives you a fair value of that, and the 50% what you've acquired. And you already know what you paid for that 50%. You paid 300 crores, which is as good as the fair value today. So I know three elements. I know what I paid today for 50%, 300 crores. I know what is the NCI, there is 30%, 120 crores. I know the PHI, there is 20% of 400 crores, 80 crores. So we know the fair value of all three, which makes it 100. I'm just giving you an analysis. Entity A needs to determine whether acquisition is an asset acquisition as per the concentration test. Now, let's have a look at what is being done. Let's have a look at what is being done. So I'll explain the logic. Don't worry. Just look at the technique first. The logics will come very soon after this. It says take the fair value of the consideration transferred, the fair value of the consideration transferred plus the fair value of NCI, and plus the fair value of PHI. So he's taken a sum total of three things. He's taken the sum total of three things. One is the fair value of what you paid for the 50%, the fair value of the PHI, and the fair value of that NCI. So fair value of the consideration paid plus the fair value of the PHI and the fair value of the NCI, that makes it a total of 500 crores for that 100%, for the 100%. That means if you look at the value of the 100% stake in the company, it is coming to 500 crores. Then it says fair value of the liabilities assumed is 800 crores. So these are the financial liabilities given, but this is excluding a deferred tax. So then he's also given the cash and cash equivalents, that is 200 crores. Now what he's done, don't worry on the logic. I'll give you the logic. Don't worry on the logic. What he's done, he's calculated something called the value of the gross assets, which is the sum total of 500 crores. That is the sum total of the consideration, PHI and NCI, plus the liabilities and minus the cash equivalents, that is 200. So if you take 500 plus 800 minus 200, that gives you the gross value of the asset. So he's taken the sum total of the consideration, PHI, NCI, plus the liability, excluding DTL, minus the cash equivalents. You get the value of the assets, 1100 crores. And then what he's done, he's gone back to the list of the assets. And if I go back to the list of the assets, oh, where did I go? Oh my God, just give me a second. So in terms of the list, oh, did I clear all that? Oh. Just give me a second. Okay, here I am. Sometimes the file gets closed. Just bear with me for a second. Let me just come back on the example. Yes, so here we were. So then what is done after this? So then what he's done after this, he has taken the gross value of the assets, and then he's taken that which asset is approximate to that 1100 crores. So he's identified that building which is to the extent of 1000 crores. So that building is 1000 crores. So we can say that out of that 1100 crores, 1000 crores is concentrated in the building. If you take that percentage, 1000 divided by 1100, it comes to almost 90%. So 90% of the fair value of the asset is concentrated in the building. So you know what? So we did not understand anything. I know that's what you want to say. So we did not understand anything. What is this? We didn't understand. We were trying to catch up with the fact that you added something and then suddenly you went to some calculations. We didn't really understand that. Am I right? Is my psyche absolutely correct on this? Did you really understand what is happening in this case? Say a no. So now let's, I think, explain the logic to you that why did the standard setters create the concentration test and what is the logic of this concentration test. I mainly now need time and it will take me around 10 minutes or so in order to explain the logic of the concentration test. You want me to give you the logic or just the steps, what do you need to do? If you want me to give you the steps, I'll directly give the 3 steps. If you want the logic, then I'll first develop the logic and then give you a 3-step model on the concentration test. Okay, so we get the answer no, we did not get the logic. That's great. That's great. Okay, so let's come back. Just keep that illustration at the back of your mind. And I'm just going to come back with the logic. So let me just come to the logic. Please hear me very carefully. The next 10-15 minutes is going to be very crucial, because you will understand the nitty-gritties with the logic that how the concentration test was actually designed, for which I just need to take you slightly ahead in the standard, but something which you know based on amalgamation. Okay, just give me a second. It's getting uploaded. Yes, it's done. Okay, so let me now come to the concentration test. Watch this carefully, friends, now. So let's have a look at the concentration test. Just hear this very carefully. The next 15-20 minutes is going to be very crucial. Just remember what you did in terms of IGAP. Just recall what you did in terms of IGAP, that is Accounting Standard 14, amalgamation. I'm taking you back on the CA intermediate days, and I'm just reminding you what you did in terms of Accounting Standard 14 when it was amalgamation in the nature of purchase. Watch this. We used to put the entry assets were given a debit in the entry, liabilities were given a credit in this entry, and a purchase consideration was given a credit. And then you used to take a balancing figure in this entry, and the balancing figure in this entry used to be generally called a goodwill if your credit side was more than the debit side. This is what you did in terms of amalgamation. So we used to put an entry, there is assets, liabilities, and then the purchase consideration. So if your consideration was more than the net assets which were taken at a fair value, then the balancing figure became goodwill. Trust me, business combination standard is almost quite similar, but of course the nitty-gritty is a little different. So if I look at in terms of Ind AS 103, if I look at in terms of Ind AS 103, let me give you what is the entry. So this is what is technically called an acquisition accounting. Quite similar to what you've done in IGAP Accounting Standard 14. So we say that if you acquire a control over the business of another company, there is an acquisition accounting entry which is done. Now watch this carefully. That's what we're going to learn later. So I'm going to record the net assets in this entry, and the net assets in this entry will be taken at a fair value. And then you take a purchase consideration, which is taken on the credit side, and automatically you take a balancing figure in this entry, and the balancing figure in this entry is what we call goodwill. Quite similar. Now, let me introduce a few inputs to you. Keep hearing this very carefully. You know, when you net assets, this is 100% of the net assets of the company. But it is not necessary that you would acquire all 100% voting power in the company. You know, if you need to get a control over a company, you acquire more than 50% stake, you get a control. So it is not necessary that you would acquire 100% stake. So what can happen? When you acquire the shares, let us say you acquired a 70% shares. So when you acquired 70% shares, you can see there is a complete mismatch in the entry. Your debit side of the entry is 100% of the net assets. And the credit side of the entry is only the consideration which is paid for 70% voting power. Now, in this particular case, this mismatch would get eliminated when we record on the credit side NCI, which is held by the 30% stakeholders. So it would remove the mathematical, disturbance in the entry. Now you can see the purchase consideration is supposed to be 70% and the NCI is 30%. So you can see now it becomes 100% and the net assets is also 100%. So it's a mathematical disturbance gets eliminated. So on one hand, you've got the net assets, which is 100%. And on one hand, you've got the sum total of the PC and the NCI. Now remember, what is this PC? In the given example, you already had a 20%, you acquired another 50%. Which means in order to get the consideration which is paid towards 100% stake, mind each and every word. Thus means that in order to get what is paid towards 100% stake in the company, you need to add three elements. You will add number one, the PHI, that is 20% in the example. You need to add the consideration paid for the 50% acquired right now. You need to add the 30% to the NCI. So when you add the PHI, the consideration paid and the NCI, you get what is the amount which would have been paid for 100% net assets. Agreed? So the sum total of, you can say, PHI plus NCI and plus what you paid now, the sum total of this is what is paid for net assets. Mind you, what is paid for the net assets, not assets, not assets. The purchase consideration, what is a sum total of all these three, is what is paid for the net assets. I don't need what is paid for the net assets. I need what is paid for the assets. So, but why do you need what is paid for the assets? Because I need to see that the consideration which I paid for the assets, which asset is got a value approximate to that value. Since it is a consideration paid for the net assets, what do I do? If to this I add the liabilities, will I be able to get what is paid for the assets? Will I be able to get what is paid for the assets? Oh, yes. If you add the amount of liabilities, you will able to get what is paid for the assets. So what you paid for the net assets is available to you. And when you add back the liabilities to the consideration paid, it moves up. So it tells you what you paid for the assets. But when you add the liabilities, you need to consider that you don't add up adding the notional liability. A deferred tax liability is supposed to be a notional liability. So if it is a notional liability, then when you add back the liability, you should not add a notional liability. So remove the DTL, just add the liability. So in this example, if you notice, when they took the sum total of this, it was 500 crores. And then when added the liability of 800 crores, you came to know that 1300 crores is paid for the assets. You came to know that 1300 crores is paid for the assets. But what you paid 1300 crores for the assets was also giving you the cash. What did you pay for the cash? You pay for the cash what you get. I got 200 crores of cash, so I paid 200 crores for the cash itself. So let's remove the cash. Because I am interested in finding out what is paid for the assets other than cash. I want to understand what did I pay for the assets other than cash. So what do? From this, you reduce the amount of cash as well, the cash and cash equivalents. So the logic is that when you add to this the liability, you are converting what you paid for the assets. When you reduce the amount of cash, you come to know what is paid for the assets other than cash. So when you took this figure 500 crores, you added the liability 800 crores, reduced the cash 200 crores, you got 1100 is paid for all the assets other than cash. You came to know that what is paid for the assets other than cash. And I said that out of this building is got a value which is 1,000 crore. I paid 1,100 crores for all the assets other than cash. And one of the asset is got a value 1,000 crores. So practically I paid for the building. Because if you take 1,000 divided by 1,100, this percentage comes to almost like 90%. It is considered to be substantial. When 90% of the consideration is concentrated in a single asset, then we can say that yes, this is not a case of business. I guess I made more sense. Ye dil maange more, so you want me to put this once again, I guess, friends, but I think you would have understood a little better. Let's, I think, consolidate this in a 3-step model to understand things even better. So let me see if any questions coming so far in between, otherwise let's take further. Okay, so yes, now I think let's get this. So you need to understand one thing, that when you acquire a control over a business, you get a control over the 100% net assets of the company, because you would already know, based on your previous knowledge, that when you get a control over a company, whether you get 80% stake in the company or a 60% or 100% stake, you always consolidate all the assets and liability 100%. So in my acquisition accounting entry, when I'm going to record the net assets, it will always be 100%. Whether you buy 70, 80, 100% shares in the company, that doesn't make a difference. The value of all 100% net assets gets recorded in the entry. So when you record a purchase consideration, you may have acquired less than 100% stake in the company. So the remaining stake is with the NCI. To get a accurate amount of goodwill and to get a mathematical parity, what you are saying that this consideration is for 70%, the NCI is for 30%. So the purchase consideration plus NCI equals 100. The purchase consideration includes two components. Maybe there was something which was held previously. So there is a PHI and what you paid currently. So the controlling interest has got two elements, what you paid now and what you paid previously. And you've got a non-controlling interest. So what do? You should first of all get the consideration for 100% net assets. You need to get the consideration for 100% net assets. So if you need a consideration paid for 100% net assets, you need to add the previously held interest, what you paid now, and the NCI. You will get the figure that, okay, this is the consideration which is indirectly for getting 100% net assets. But I need the consideration which is paid for 100% assets. So the mathematical logic tells me that to this amount, you add back the liability. If I would not have taken the liabilities, I would have paid more. If I would have not taken the liabilities, I would have paid more. So add the liabilities to this. And since you are making a payment and in return, you're getting a control over cash as well. So the amount what is paid for the cash can be eliminated, because I need to see the assets acquired other than cash. What did I pay? Because for cash, I'll pay cash. So what we do, we reduce the amount of money which is paid for the cash acquired so that we are able to derive the value what is paid for the assets. This is called gross value of the assets. This is like step number 1. Don't worry, I'll give you the chronological notes. This is like step number 1. You need to get the gross value of the assets acquired. Then step number 2, identify the asset which is a single or similar group of assets. Mind the word. The step number 2 is identifying the single asset or maybe group of assets which are similar in nature, where you feel that the fair value of that particular asset is substantially equal to the gross value. Step number 3, take a percentage. Step number 3, take a percentage, and that's how you are going to get if the percentage is substantial. Now, what is substantial? Not defined in the standard, but if the percentage is almost 90% plus, we would say, okay, it is substantial. Therefore, the value of the consideration is concentrated in a single asset. Therefore, it's not a business, it's an asset. I guess, friends, making more sense. Don't worry, I'll give you the notes as well, but I hope I'm making sense. Rahul, so no gross assets and liabilities in entry to be recorded, only net assets. No. When we'll come to the entry, we'll be recording the individual assets and liability. But for the time being, just to give you an explanation, I put net assets. But otherwise, we'll be recording every asset and liability, on a separate basis in the entry. Okay. So let's do one thing. Let's, I think now, get back to the example once again with you. And based on that example, let me just first quickly come back to the example. And then I will give you the 3-step model on the concentration test. Now watch this example once again with me. Just have a look at the example once again. Let's have a look. So watch this carefully, and you will get the entire inputs in this case. So watch this carefully. So my mind is working very clear on step number 1. My mind is working very clear on step number 1. What do I need to get? Let me ask you a question and vouch me. Do you need to get what is paid for the net assets? Or do you need to get what is paid for the assets? Or do you need to get what is paid for the net asset, for the assets other than cash? There are 3 options. And Namrata, so why we consider it assets and not assets? No worry, you'll shortly get the answer. Let's get the focus first. Do you need what is paid for the net assets? Or do you need what is paid for the assets? Or do you need what is paid for the assets other than cash? I need what is paid for the assets other than cash. So the step number 1 is called gross value. The step number 1 is called the gross value. The word gross means that I'm going to add back the liability. So it is called gross value of assets. The step number 1 is getting the gross value of the assets. Now see what I'm going to do in terms of gross value. There are 3 elements. You acquired a 20% stake. You acquired another 50% stake, and 30% is with NCI. Now, we've got 20%, we've got 30%, and we've got 50%. I need the fair value of every component. I need the fair value of every component in this. If I need the fair value, so what is the fair value of that NCI? It is 120 crores. I need the fair value of the PHI. It is 80 crores. Sorry, this was 120 and this was 80, I'm afraid. So this is 80 and this is 120. So fair value of that NCI is supposed to be 120 and PHI is 80. And what is paid for this 50%? It is 300. If you add this, it comes to a total of 500. Is this makes it 100%? Yes, it makes it 100%. It makes it 100%. This is what is paid for net assets. You'll agree. This is what is paid for the net assets. So what is paid for the assets? Let me add the liabilities. But when you add the liabilities, we won't add what we paid for a notional liability. DTL, DTA is notional in nature. So we are given financial liability, we are given DTL. I'm not going to add what is the notional liability. I'm just going to add the actual liability. So the actual liability is 800. So we get a total of 1300. Is this the amount paid for the assets? Yes, it is the amount paid for the assets. So as a part of the list of the asset, you've also acquired cash and cash equivalents. So basically for 200 crores, you would have paid 200 crores. So why do you need to consider that? So why do you need to consider what is paid for the assets in entirety? Leave the cash, because for 200 crores, you'll pay 200 crores only. So let's reduce the amount of money which is paid for the cash acquired. So let's reduce the cash and cash equivalents. And we get the figure which is 1100 crores. This is called the gross value of asset. Is this the money which is paid for the net assets acquired? I think because I'm using too many files at the moment, it is getting a little mixed up. My goodness. Oh, my God. My file is a little lost. Let me just come back. Sorry for the trouble, friends. I've opened up too many files with this, so I think it's creating a little trouble. Just bear with me for a time. So let's come back to the chart. So step number one is taken care where we said that, okay, this is the amount which is paid. Okay, now let's come back to the step number two. It's got a little erased. I think, let me just put it back. So let me just put it back. So we said in terms of step number one, it was a total of, let me just add the figures once again, 300 plus another 120 plus another 80. And to this, we added the liability, which is 800, reduced the cash, which is 200. So this was 1100. So this was step number one, getting what is paid for the assets other than cash. Now, in step number two, you're identifying the asset where the value is concentrated. You got the logic? Why in step one, we're getting what is paid for the assets and not net assets, right? So in this particular case, we identify that there is a building, which seems to be of a very high value. Identify that particular asset or group of similar assets where you feel that the consideration is concentrated. So identify that out of the assets, building is the only asset where a huge value is attributed. Now, in step number one, 1100 is paid for the assets other than cash, and the building is worth 1000. So you go to the step number three. Take the value of building as a percentage of step number one. If it is almost 90% plus, it indicates it's not a business. I think you would have got the logics as well. A video is stuck. Are you getting the video, friends? Is the video coming clear? Just check this again. Are you able to get the video? Too technical, I think, for the net also to take the inputs. Are you getting the video, friends? Is everybody getting the video? Okay, now clear. Okay, wonderful. Too technical, even for the system to take the load on things. But I think you would have got the logics now in terms of the three-step model, that when you're looking at a concentration test, you cannot take the building as a percentage of what you paid for the net assets, right? So when you're considering that building is worth so-and-so, it is the value of the asset. You need to take the building as a percentage of what is paid for the assets other than cash. Therefore, in step number one, you are converting the payment of net assets into assets other than cash. You're adding the liability to convert the payment for net assets and instead getting payment for assets. You're reducing the cash because what is paid for the cash is equal to what the cash acquired is, right? I guess the logic's understood well, friends. Okay, so I guess everybody's clear with the logics now, friends. I think I can document my three-step model to you on a concentration test. Let's now make a three-step model in terms of concentration. Let me close this file and let me just come back to the board. Okay, I think I am back to the board. Here we are. So let's make some notes to you now at this stage. So let me make notes on the concentration test. Okay, so let's, I think, make the three-step model to you. Let me see if any questions coming in between so far. 100% clear, Rahul? Great. Okay, I'm clear. We take assets rather than net assets. Okay, that's great, Namrata. Okay, so let's now make some notes to you, after which I'm going to first, consolidate things. By the way, we have effectively, not even started the accounting of Ind AS 103. Wow. I've just been explaining you the three-step models in terms of identifying whether it's a business combination or not. Wow. Okay. So let's, I think, now make a three-step model on the optional concentration test. Optional concentration test. So this is called an optional concentration test, and the word optional is indicating a choice on the part of the company. They want to conduct this test or not. So we'll get the three-step model. Step number one. Step number one, we'll say we need the gross value. We need the gross value of assets. we need the gross value of assets. But for your understanding, but don't write this in the exam, but for your understanding, it means what? That what is paid for assets acquired other than cash. So just to make it very clear so that once you revise, you're not in a confusion, I've just made a mention in simple words. You can say what is paid for the assets acquired other than cash. So what do you need to do in this particular case? I will first of all take the sum total of PHI plus amount paid now. So this is what is paid for the controlling, and you add NCI. So in the given example, you had a PHI 20%, you had the amount paid now, which is 50%, and you had an NCI that is 30%. That's how it makes it equal to 100%. So by adding up these three elements, you are able to get what is paid for the net assets. And then what do you do to this? You add the liabilities. To this, you add the liabilities, and that is other than notional, that is other than DTL. So you add up the amount of liabilities other than notional. So this is the figure which is taken for the liabilities. And then you reduce the amount of cash and cash equivalents. So we reduce the amount of cash and cash equivalents out of this. So let's take the figure out here. So you take the figure out here. So this is the figure which you get in step number 1. I think now the logic of step number 1 would be fairly clear, that we are converting what is paid for the net assets. By adding liabilities, you get what is paid for the for the assets. By reducing the cash, you get what is paid for the assets other than cash. Then we go to the step number 2. Then we go to the step number 2, and in terms of the step number 2, you need to identify a single asset. You need to identify a single asset, or it may be group of assets which are similar in nature. It could also be group of assets similar in nature. Though in this example, we're looking at a single asset only, but it can also be group of assets which are provided similar in nature. So identify a single asset which has maximum fair value. So identify that asset which has got a maximum fair value. In this case, the building had a maximum fair value. So you know what is the fair value of the building. You know what you paid for the assets other than cash. Comparable now. So you go to the step number 3. You take the value in step number 2 as a percentage of the value in step number 1 and convert this into a percentage and see that it is something which is substantial. Generally, it would be considered substantial when it is 90% or more. If it turns out to be substantial, that means 90% or more, I would say it is not a business. The moment I say this, we will say it is not a business. That means it is supposed to be an asset acquisition. Right. I guess, friends, I am pretty clear so far on the conceptual knowledge of the concentration test, on the 3-step business model test, etc. Now, I want to consolidate a bit further before I take you further. I want to do a little mind mapping at this stage. I know your minds must be a bit heavy, but I think you would have fairly understood as well. But a quick revision on your part, just sit down for around 10-15 minutes. And I think once you revise this entire portion, everything will just become very clear. Just a bird's eye view is required. Okay, so let me just now quickly do a little consolidation before I take it further. Okay, so let me now give you the chain of thought. I'll be sharing these notes also to you, but it'll take me a little time. So maybe the notes would get a little loaded towards the evening because I just need to edit the files because the pages are so many, so it'll take me a little time. So by evening, of course, the notes will get uploaded as well. I'll try to do it a little early as well, if possible. Okay, now just relax on your seats and hear me well. Because I want to, first of all, before I go to the next phase of discussion, I just need to, first of all, give you the clear-cut thoughts. We're just making a quick mind map in terms of things. I'm just making a quick mind map in terms of things. I have basically so far taught you a total of 3 things so far. Basically 2, but it effectively turns out to be 3. Number 1, I gave you a 3-step model. Number 1, I gave you a 3-step model, and this was with regard to that which standard would trigger. So this was with regard to that which standard would trigger. I'm not giving the entire notes to you. I'm just giving you the basic thought process so that we are clear. So I started on my journey on a 3-step model telling you that you need to understand which standard would trigger. So I said there are a total of 3 focus points. What did we buy? So the first question, what you need to put across to yourself is, what did we buy? What is necessary is that it is not a single asset. What is important in step number 1 is that you acquire a group of assets if you want to trigger 103. Because if it is a single asset, then you know that different standards would apply depending it's tangible or intangible. So the focus point before you go to the step 2 is that you must buy a group of assets. That is important. So every time you read a question, you need to see that the company has acquired a group of assets. Now go back to the example which I gave you, where we did the question on acquisition of patents and equipments. You would know that it cannot be a business because apart from acquiring a patents and equipments, no processes were acquired. So if you go back and try to understand that it was a business or not, you know that processes were not acquired. So therefore it was not a business. Then you go to the next step and says that, is it a business? The next focus goes on the fact that, is it a business or not? So that is the next key question. It has to be a business before we apply 103. So group of asset is one essential element, being a business is another essential element, and getting a control is another essential element. So when you say it is a business for this particular purpose, I started my discussion further on the concentration test and the business model test, the 3 tests we did. We'll come to that. So what is important is that, yes, it should be a business, otherwise we cannot move ahead. And then you need to see that, did we get control? I never concentrated on the concept of control because I said the control assessment is something which we go to study in Indus 110, but generally a control comes when you get more than 50% voting power in a company. So in this particular case, we should also say a yes. So there are 3 very clear focus points to be kept in mind. You need to acquire a group of assets, 1, which has to be a business, that is 2. And you need to get a control over the business, 3. If you say yes, 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 103 triggers. And apart from that, even 27 and 110 gets triggered. So this was one chain of thought which I gave you. That is a 3-step model with standard triggers, giving you insight what is a business combination. Then I gave you the concept of identifying a business. Then I gave you the concept of identifying a business. How do you decide that a group of asset is a business or not? And for this, we said that you've got an optional concentration test. You've got an optional concentration test. I'm putting it as CT, C test. It is a C test, that is a concentration test. And in the concentration test also, I gave you a 3-step model. On the concentration test, I gave you a 3-step model and I gave you a clarity. I said, when you look at a concentration test, there are 3 combinations possible. You don't want to apply, don't apply. Go for the business, the 3 business element test. So let me put it out here. Then this was a 3-element test. I call it, it's not technically called a 3-element test. It's my nickname. I've given that nickname that there is a 3-element test. So this 3-element test also I divided into a 3-step model. So as I said, the permutation combinations are, the company doesn't want to apply an optional test, no problem, go for a 3-element test. You apply this test and you fail, go for the 3-element test. You say, I don't want to apply, go for the 3-element test. But if you apply it and pass, it's an asset acquisition, it's not a business acquisition. Now, coming back to the agenda, in terms of the 3 steps on the concentration test and the 3 steps on the element test. Here, the 3 steps, what we did was, since we are interested in the consideration is concentrated in a single asset, I'm very clearly using the word, since the consideration is concentrated in a single asset, so your focus in step 1 is to get the amount which is paid for assets other than cash. So we need to get the gross value of assets. We need to get the gross value of assets in this case. So you need to remember that when you need the gross value of the assets, you need to be clear that you take the sum total of the PHI plus what is paid now plus the NCI. To this, you add the liabilities other than notional and you reduce the cash and cash equivalents. Simple. In this particular case, you add the liabilities other than notional DTL and reduce the cash and cash equivalents in this case. And then you identify that single asset. See what is the fair value of that single asset. So that mathematical parity gets developed, that this is the fair value of that single asset and this is what we have paid for the assets other than the cash amount. And then you take the percentage, the step 2 value as a percentage of the step 1 value, express this as a percentage. It should be 90% or more technically, though the percentage is nowhere defined in the standard. But technically it has to be substantial. Substantial would generally mean that it is 90% or more. If you say, yes, it is substantial, I would say it is an asset. It's not a business. So this is the concentration test where I did that example, which is given in the study itself. We did one of the examples out here when it was not a business. That was also in the study. We did an example on the concentration that is also in the study. And then I came to the 3 business element test with you, the 3 business element test as well. Now, in terms of the 3 business element test, we said we've got 3 steps again in this case. The focus in the first step is that you acquired an input along with a process. So what is more focus in terms of the step number 1 is that you must acquire a process. Without a process, it will never be a business. Simply acquiring inputs doesn't make sense. The presence of the process is necessary either in the form of organized workforce or maybe in the form of some formulas or any kind of things which will convert into output. And then the second focus is only to see that the output is there on the date of acquisition or it is not there. That's simple. The presence of revenue means output. The non-presence of revenue means no output. And then when you say that there is no output in this case, then there is a little stringent test. You've got 3 parameters in this case. I've already given you the list of those 3 parameters. You need to see the process is critical. You need to see, number 2, that there is an organized workforce, and you need to see that there are other inputs as well. And if there is an output, you've got basically 2 parameters in the block 1. You meet them, or there is 1 parameter, you meet that 1 parameter, either of them, it would be a business. The 2 parameters are same. The process is critical and the output and the organized workforce is there. Or just prove it to me that the process is unique, scarce, or cannot be replaced. If you prove the 3 parameters or the 2 and 1 parameters business, otherwise it is an asset acquisition. We did a couple of case studies on this area as well. So now you should be very clear on the concept of business identification using optional concentration test, the 3-element test, and of course, which standard triggers when. I think the comfort zones should be very good. You would be very sound in terms of understanding the nitty-gritties of the standard. Let's take it further. Let me see in the meantime, before any questions are coming to your mind. Okay, I guess, yeah, thanks, Namrata. Rahul, you said, so we will not get confused in business combination as they're not as there are a lot of standards 103 and all. No, you'll not definitely not get confused on that, because if you know the chain, which standard applies when, that's not going to be difficult. And how to approach a business combination and financial instrument when it comes to revision. I think, when you go with a step-by-step approach, and if you keep revising illustrations for every concept, trust me, you're going to go very strong. As you rightly said, my piece of advice to everybody would be that, once we're doing the standard, once do one thing, as I revise, keep doing a cumulative revision. So when I do class 1, revise it. When I do class 2, revise 1 and 2. When I do class 3, 1, 2, and 3. Then once the standard gets over, please do a comprehensive revision, because these standards are complicated. And since they're complicated standard, it involves a lot of efforts on your part as well. Because once you revise the standard in an entire go, you will get the missing links and the complete chain. Because what is most important is that you should be able to, get a clear-cut framework in your mind regarding the flow of the standard. Everything should be very crystal clear that this is how I need to proceed at each stage. Getting a chronological order of movement is very clear, but trust me, I'm going to do that in the standard. A very clear, Rahul, that's great. And Kaushi, so how to determine whether the process is critical or not? Well, since from the examination point of view, there have been no questions asked on that area, I really didn't get into that. Because practically, yes, it could be a challenge, but examination point of view, I just, gave you the inputs that it is critical. Critical only means something which is unavoidable, without which I can't do anything. It is something which I badly need. Without this, I can't do anything, then it becomes critical to that extent. Okay. Right, friends. So I think now let's take it further. So I'm just going to take you to the next chain of thought and develop something further with you. So let me just take you to the next chain of thought. Now, having understood that it is a business combination, let me just, I think, now give you some idea on the next part. So this is where our discussions will go forward, moving forward. Now, when you identify that it is a business combination, please hear this carefully. This is another crucial 5 minutes. So when you say that it is a business combination, you have already identified to be a business combination. Now, there are a total of 3 possibilities. How would you identify these 3 possibilities? We'll see that, no worries. But there are going to be 3 possibilities. Every practical question on a business combination would fall under either of these 3 categories. One is a case of acquisition accounting. One is a case of acquisition accounting. Now, don't get worried on when does acquisition accounting apply. I'm just telling you at the time being that business combination questions can fall into 3 categories. You can get 3 categories of questions in a business combination. One is called acquisition accounting. The other one is called a reverse acquisition. The other one is called a reverse acquisition. And the third one is called a common control transaction. It's called a common control transactions. Now, don't get worried at this stage that when is it a reverse acquisition? Sir, how will I see the question and identify that it is a common control or is it a reverse acquisition? This is what we need to develop. So no worries on that. That's what we're going to develop. But let me tell you one thing very clear. 2 things rather very clear at this stage. The guidance on reverse acquisition is given in terms of Appendix B to the standard. There is an Appendix B which talks in detail about a reverse acquisition. So I'll give you a flavor of a reverse acquisition to begin with, but we'll discuss it separately. We will discuss the concept of reverse acquisition as a separate game. And the concept of common control transactions is given in terms of Appendix C. So since they are specialized kind of accounting, the standard in Appendix B talks of reverse acquisition accounting, and the standard in Appendix C talks of a common control transaction. And if you look at the main part of the standard, the main part of the standard is talking of acquisition accounting. But let me give you one input to begin with at least. When you apparently look at a question, you can see the transaction is with a related or unrelated party. Generally, I'm saying generally, if your transaction is with an unrelated party, If your transaction is with an unrelated party, it would be a case of either acquisition accounting or a case of reverse acquisition. But if it is a case of, you can say, a related party transaction, then it could be a case of a common control. So common control would generally arise when there is supposed to be a related party transaction. For example, a transaction between a parent and a subsidiary. The parent who already has a control over the subsidiary is planning to acquire the subsidiary. So when there is a related party transaction, it could indicate a common control transaction. Demergers, for example, I don't know if you know what a demerger is, but I think one of the best examples for a common control transactions would be a case of demerger. I don't know if you know what a demerger is. No worries, I'll be coming to that part as well. But demergers would be, like, for example, there is a company which is into two lines of businesses, and they plan to demerge one of the businesses into a separate company altogether. But the shares of that company is given to the existing shareholders itself. So we'll see that basically common control is going to be related party transactions. So let's forget about common control transactions at the moment. So we will basically view that if in a question there is a transaction, we need to reach a conclusion that is it a acquisition or reverse acquisition? How do we do that? Don't get worried on that. Now, what my focus from the next class is going to be, I'm basically going to concentrate in terms of the acquisition accounting, where I will give you a 7-step model. I'll give you a 7-step model. So we are going to work on the 7-step model. So we're not going to talk of acquisition accounting. We're not going to talk of common control, but we're going to concentrate only with reference to the 7-step model on acquisition accounting. This 7-step model is going to comprise of a certain sequence, which I would say you should religiously follow. You need to consider number one. I'm just giving you the steps offhand. Don't worry, we'll be coming to these steps later. We'll see, first of all, who is the accounting acquirer. We're going to see what is the acquisition date. We're going to see what is the list of the net assets acquired. We're going to calculate a purchase consideration. We're going to calculate the amount of NCI. We're going to calculate the amount of goodwill, or what we call a bargain purchase gain, which is called a capital reserve. And then we're going to pass an entry, which is the acquisition entry, which I just showed you a little while back in the concentration test. So once you are clear with all these 7 steps, believe me, even if you get a larger question which is containing all the 7 steps, because you may get a question which is concentrated only on a single step, the examiner may ask you a question just on the basis of, let's say, a particular test, or he may ask you a question which is based on, let's say, a full 7 steps as well. So what I'm going to do, I'm going to cover these steps one by one. It's not that I just want to give you a basic flow of the 7 steps and run to a question. We will go a little deep into each and every step, understanding, of course, the target, the journal entry, and so that we are able to do some larger questions with you. So I think I'm not taking this further today. I think let's not hurry up on this. So in the next class, friends, I'm going to start with you the concept of the 7 steps, that is acquisition accounting. So let me see if we've got any questions so far. Otherwise, we're going to call it a day. So clear up till now. That's wonderful indeed. So any question, friends, coming at your end? And if not, then I think we could call it a day. I'm going to join you on Thursday at the same time. So let's see if there are any questions. I guess nothing so far. Right, friends. So I think on that note, then I'll take leave from you, and I'll see you in the next class. Thank you very much. Bye-bye and take care.